We are. Let me just make sure we're live. Okay, 1 second. Beautiful. Okay. And I'm going to change the title of this thing because it says simply Bitcoin. It says live with Charlie Morris. Alice Pulse. Okay, great. Okay, Charlie. Well, thanks for jumping on. I've been following you for about a year now, and I've been following this Bold ETF service as well, pretty religiously since these Bitcoin ETFs came out. I feel like some of your data has been some of the best out there.
Great, thank you for saying so.
Yeah, because you basically have agglomerated under ByteTree some of this stuff, which is both the both the domestic ETFs, but also all the international ones as well. And I think that's was kind of a missing piece. And another Brit, James Van Stratton, kind of led me to you, and he was like, yeah, this, and I go, yeah, I think I follow him already. And then he's like, yeah, but this ByteTree stuff is amazing. And I'm like, yeah, really is. So thanks for coming. Why don't you kind of introduce yourself? Yeah.
Introduce myself. Yeah. So
yeah. So just tell us your background, and I know you've been into gold forever, but give us your background a little bit.
So I'm 25 years ago, no, I can't even count these days. I'm so old. 1998, I joined the City of London. I joined HSBC Asset Management. I was there for 17 years. I started a absolute return portfolio, grew it to 3 billion by 2008, and then left in 2015. It was a fabulous portfolio structure, set up very much on the basis of how the Swenson type portfolios for private wealth. And, it's like a third bonds, third equities, a third alternatives. And those alternatives, right. Gold was in there, other commodities, hedge funds, private equity, CTAs, these kind of things. And so it was just a diversified portfolio. And I'm sure you remember, Fred, that between 2000 and 2008, the diversified portfolio worked really well. And then in 2008, it was only bonds, the government bonds that held up, everything else went down. And maybe the dollar, the yen, and the Swiss franc. And then now in the everything bubble, who knows? We are looking for the dream hedges.
Right. Well, look, I mean, one of the charts that you had was really kind of an eye-popping chart, because I've owned gold since 2000 and since 1994. Since I've owned physical gold, I still have it, just bars of gold. But, it's always very tricky to say, how did gold do versus other things? And, I love the chart where you have it on starting in 2000, right? And it's really interesting because that is a pretty that's a point in our reference, right? Because 2000 was kind of the end of the stock market bubble, right? The beginning of really the real estate bubble. And, kind of gold was kind of not really on people's radar in 2000, right? And now, flash forward 24 years later, how did gold do? Gold is up 8.5 times, right? Since then, maybe even a little bit more today, maybe 9 times. Stocks, S&P, your total return of the S&P is like 5.5 times. And so gold has trounced the S&P, okay, over that period. Now, obviously, everybody's like, well, you're cherry picking, you should look at it from, 2010. And it is true that we remember now FANG, we remember these, and really, we also start from the bottom of the 2009 crash, right? So we're like, oh, stocks have done great since January 2010, which they have, right? But, gold has really performed over these long periods tremendously well.
It has indeed. And I think, obviously it is cherry picking timing, and I'm not going to apologize for that. There's a bit of fun in it, but there's also some nice, it's a nice date, isn't it, at the beginning of the century? So it is a nice coincidence as well.
Right.
End of an era with the dot-com, as you say, a big rotation of growth to value. There were many things that happened around that time, Y2K, and really it was the beginning of the emerging market boom. And of course, most of the emerging markets since that same date have also outperformed the S&P as well, even though people only remember them being terrible since 2010, as you rightly point out. So it's the same idea, this big rotation of value growth, or tech versus non-tech, or US versus rest of the world, however you want to describe it. It seems to keep on repeating itself. And so we've just been patiently waiting for the next big rotation. And I think that's, and where is Bitcoin in the rotation? That's a fascinating question.
So I want to hear I love your narrative. So why don't you walk us through really super high level narrative of what's happened since 2000, over 2000 to 2010, 2000, since we had the QE stuff, and kind of where we are now, kind of in like super broad strokes narrative, because you just brought up Bitcoin. That's a new thing, right? And it's a new thing for financial people, right? To me, it really just started on January 11th. That's really the beginning of Bitcoin for TradFi.
Sure. Well, let's make sure we pick up on the launch of the gold ETFs in 2003. We'll come back to that as well. So what happened? The 1990s, spectacular decade for the stock market, but of course it wasn't equally shared, that love. It was very much Western world focused. Japan had blown up 10 years earlier in 1990, so that had a weak decade. Asia had been mixed, but then it had a crisis in 97, 98, and that was on a currency peg basically blowing up. There was also the Russian default and LTCM. So you came into 2000, and it was Europe and the US were seen as a safe haven, and it was TMT, telecoms, media, tech stocks. The techs were more junior then because they weren't as established as businesses, but the telecoms were the big deal, really. It was, my God, the transformation in telco was amazing. Before that, before 1999, you paid for a phone call in most countries. To call you would have been, in money in those days, $2 a minute or something. I mean, seriously expensive to have a phone call. A video call like this, you could probably do it with the right technology. I'm sure governments had it, but it would cost you a lot of money to do this sort of thing. So the transformation began. The internet was like the internet stocks were like crypto today. There were no profits, but there was big dreams, no profits, and those dreams turned out for the internet. I mean, hardly anyone got the right stocks in 1999 because very few of them actually existed. Microsoft existed, Apple existed, Amazon sort of existed, but it wasn't exactly established. But Google didn't, Facebook didn't, Nvidia, I think it just IPO'd or soon to IPO, something like that. And Tesla didn't. So
and the stock that everybody was trying to pile into didn't do so well. Cisco.
Sure. Yeah, still down all those years, and that was the number one sort of this is the future stock, and it basically made the engine to the internet servers, and they were doing that, trade finance where they were lending their customers money and this kind of thing. So they were bringing forward sales and then you kind of realize it wasn't that hard to make a server after all, and China came in and supplied them, and then this sort of thing. And the parallel with Nvidia today, of course, is that they make the chips for the AI, and you just got to assume that it won't be that many years before someone else figures it out.
Okay, so then we had the crash, the 2000 crash.
Yeah, and then, I remember having a conversation with a young lady in London. And she said, "What's your favorite stock?" She's obviously a city person, working in the financial sector. And she said, "What's your favorite stock for the next 10 years?" And I mentioned this Thailand closed-ended fund that was trading at 50 cents on the dollar, so discount to NAV, 50% discount to NAV. And she looked at me like I was mad. But what did Thailand ever invent? And it's like, well, it doesn't matter. It's just a bunch of assets at half price, and they pay a yield, and the country's growing, and those assets will be more each year. Be worth
very much the Jim Rogers kind of philosophy there. Yeah.
And guess what? Tech went down, and those sort of things were all snapped up. And over the next 10 years, they did spectacularly well. I mean, Indian equities, for example, Brazilian equities, these sort of things did not go down in the dot-com 2000, 2002 crash. They did not go down. And you really felt it on 9/11. It was a very scary moment, 9/11. But then when it happened, it was what was the impact on the stock market. The stuff in a bear market really broke new lows, and the other stuff just resisted and just held. And there was a bid. And you suddenly realized that the whole world was underweight 80% of the population, 80% of the land mass, and that kind of thing. And so the EM trade became very powerful for the next decade. So yeah, that was exciting. And tech underperformed. Tech was not very exciting before 08.
Yeah, right. Okay, so we had this decade of emerging markets, and of course we had in the U.S. this massive real estate bubble that just kind of blew up out of nowhere.
Yeah,
and then we of course had the Great Recession, or the Great I don't even know what they're calling it anymore. The 2008, 2009 crash, the Big Short. And then out of that, now tech comes back super strong, right?
yeah.
Now we really, then from 2010 to 2020, pretty much, it was all tech. That's it, right?
Can we go back to 2010?
Yeah. Oh, we also have missed the gold IPO, the gold ETF in 2004.
We'll come back to that. So in 2010, and I think it was 2010, maybe it was 11, and Greece was blowing up, and those European bond spreads and these kind of things. So one of the other little crises, which wasn't solved, it was just buried, like so many of them. And what was fascinating was the NASDAQ 100 index, and I stress the 100, was less volatile than the S&P 500 index.
Holy cow.
And so, so you had this extraordinary, very strange situation, and quite a lot less volatile. And so the NASDAQ in 2010, these internet companies started to make huge profits. At the same time, the biotech companies were just coming through as well. And so suddenly this index that everyone sort of laughed at, sort of take pity on this company, these companies that have to perennially raise money. And then suddenly they just start making bucket loads of cash. And you really saw it in the crisis where the NASDAQ never went down. And the S&P did, because the S&P had banks in it and had, things with problems exposed to Europe or whatever. And the S&P the NASDAQ just didn't. So that was another a very special moment. And we are looking, I think, if the volatility picks up here, we are looking for the areas that just shrug off the problems. And I think that would be a very telling thing today. But should we go to the gold ETFs?
Okay, gold. Let's do the gold.
Yeah.
ETF.
So gold was obviously a big deal in the 70s before the ETF structure existed. And I don't really know what people did then. I think they bought it physically and they probably bet on it somehow, or use futures. But basically gold was very difficult to put into a portfolio in the 1980s and 90s. Of course, you can buy gold, Fred. I mean, we all know you can go and buy gold coins and bars, but that's not in a portfolio. What I do, put it in my drawer and say, client James and client Chris. It doesn't kind of work in a robust manner. So having a ticker and a CDOL code and an ISIN code, these things are more credible. Hence the Bitcoin ETF. But before that, the precursor was the gold ETF. First in Australia in 2003, then in London in the end of 2003, then in New York at the end of 2004. And by the time it hit New York, it was a fanfare. There was huge amounts of talk about the gold ETF. So I think it was a big deal at the time. And people slowly just went, you know what, in that sort of side part of a portfolio, just in case bit, I'll have a hedge fund, I'll have some gold and that sort of thing, and maybe a couple of other things. And just the size of the gold ETFs just grew and grew and grew. And then in the credit crisis in 2008, Americans will say gold went down, but most of the world say it didn't go down because the dollar went up, right? So it depends on how you look at it. So if you looked at it in pounds, it was flat. If you look at it in euros, it was flat. And then it rebounded very quickly because we hit the negative interest, the negative real rates. They just got the rates down on the floor, and the bond yield kept coming down. And so, gold was just, why wouldn't it go up? And I think by 2011, people had just sort of said, well, this is too far too soon. And the recoveries of the economy really sort of started to kick in. And I think that people said, well, the banking crisis, yes, it was a big deal in 2008-9, or 7-8-9, but what they had done had buried the problem, at least postponed the problem for a long time. And so this need for this big hedge wasn't required. So when people say gold's done nothing since 2011, well, it's true. It's done very little since 2011, but it was a bubble in 2011. It went to $1,900. It probably never needed to go much above 400. So actually, if you sort of say, well, had you not had a bubble in 2011, then actually the sort of fair value of gold back then was probably a third lower than today.
Okay, so that and by the way, the gold flows kept on going for ages, even after the peak of the market.
Because Fred, you know how it works. You've got an institutional investor who's not a person; it's a group of people. It's groupthink, and they look at the gold ETF, and they might have read in the papers it's launched, but then it won't come onto their agenda for another 3 or 4 years.
Hold on, time out. 2 minutes. Okay, what? 2 minutes.
This is a normal Fred video. The postman's at the door. He's delivering gold bars.
Sorry about that. It is
No problem.
that's the new reality.
What kind of dog you got?
I got a very eager Australian Shepherd. That's what we got. Her name's Alaska.
Very good.
Very good dog. Good dog. Good dog. Okay, so now we get to we get there. Gold blows up. Good.
This is Cosmo. Right. Enough of that.
Okay, so now we get into Bitcoin starts coming on the scene. When do you start taking notice?
2013. 2012, someone tells me about it, and I laugh it off. And 2013, I see it and realize you can't. When I realized you can't cut and paste Bitcoin, which the penny dropped, and this blockchain thing makes it work. So once you figure that out, then actually you realize, oh, it's pretty real. So I figured out the supply side quite quickly. Then it was just about trying to understand the demand side. Do people actually going to want this thing? And I got very excited about it and realized it was a friend of gold's early on. I don't see it as competition. I just see it as another alternative. If anything, it's probably taken the shine off the silver market more so than the gold market. In pre-Bitcoin days, during these sort of macro moments, people would talk about silver all the time, and now people don't bother anymore. So I see it that way. And it just, it's just been a fantastic experiment to start with. And it just kept winning every battle. And every time you had a reason to doubt Bitcoin, whether it was the fork or some regulation or some exchange blowing up or whatever the hell it was, it just came back each time. And you look at things like the stable coin, which, the banks will try and switch off flows to the Bitcoin networks and Bitcoin exchanges and stuff. And then, the crypto space comes up with the stable coin. And it's just every single time there's a solution to the problem. And I just think it's just been phenomenal to observe it. And it's been a crazy 10 years. But I've been following it closely since 13. I first wrote about it in November 13. And I've been writing about it probably more consistently for the last 3 or 4 years.
And so, those of us who've been in a little bit of time, it now occupies a pretty bigger chunk of our portfolios just because it's gone up, right? More than other things.
Yeah.
But if you were starting over right now and you're looking at it, and you weren't allocated, and Bitcoin's at 63,000, what kind of an allocation would you put for, so let's say, a middle-aged guy? What kind of an allocation would you look at, and how would you allocate versus gold?
So I'm going to give you a really theoretical answer, which your readers, your viewers are going to hate, but I'll give it anyway. So the correct answer to how should you invest your money is a 60-40 portfolio. Even though I hate them and you hate them and everyone else hates them, that is the official thing to do with one's money. And so you have 60% in equities and 40% in bonds. And if you go to the World Gold Council and look at their academic studies, that they've done, they say that you could actually put 5 to 8% of your bond, 5 to 8% of your portfolio into gold and take it out of bonds. Yeah. And but a casual observation of the Bitcoin market says that if you look at Bitcoin, what does it correlate with? Well, the stock market, specifically tech. So, and it has done for years. It used to be social media stocks more so than raw tech, but now it just seems to be raw tech. And so that's fine. So you just take a little bit of equities out and put some Bitcoin in, take a little bit of bonds out and put your gold in. And the way I would balance them is how I've created the bond index, which is the risk weighting, which basically takes you currently to 1/4 Bitcoin and 3/4 gold. So my theoretical answer is, let's call it 7.5% in gold taken from bonds and 2.5% in Bitcoin taken from equities.
Okay, so you're still pretty traditional, I would say, with respect to the equities part of the.
Yeah, but that's what I'm just telling you what an institution is going to do. So
No, I understand. I get that, but like,
yeah.
What about some guy comes to you and it's not an institution? It's a guy like me,
Yeah.
Comes to you and I'm like, Charlie, you seem to be on top of this Bitcoin thing. You
Yeah.
also seem to be quite on top of the gold thing.
Yeah.
And obviously you've been buying equities for, the better part of 3 decades.
Yeah.
Where do you see, give me a mix right now between those 3 asset classes, gold, equities, and Bitcoin.
Okay. So we'll now go to the Talmud from the Old Testament. And
yes, we're going Old Testament now.
We're going Old Testament. So this is my second answer. This is my more absolute return answer. And he says, may each man have 1/3 of his money in gold. And so I'm gonna switch gold to gold, and we're now going to go to 33% in the combination with basically 1/4 in Bitcoin, 3/4 in gold. That's my
more gold than Bitcoin.
Yeah, risk adjusted is key to understanding this, because if you're seeking highest returns, then that's a different outcome. We're not necessarily seeking highest returns, and there's a non-zero chance that Bitcoin doesn't make it. It's not
But
guaranteed.
Aren't we seeking highest returns 10 years from now?
Fine. So what I've done in the gold index is rebalance. Yeah. Okay. So we rebalance every month, and there's an alpha in that. There's 5 to 7% annualized excess return from rebalancing between Bitcoin and gold. There's also the other thing we do is we look at we've got a website called bold.report. All this stuff's there, all the charts and everything.
I'm going to put a link to it, by the way, because this bold stuff is absolutely amazing. And you guys know I'm a stickler for this stuff. I don't recommend sites very easily, but this bold stuff is great. It really is top quality.
The thesis is really simple. That I spent a couple of years in a derivatives firm, and it wasn't my thing to hang around and make a career, but it was a really interesting learning curve. And the way the derivatives industry understands volatility, that most people don't even bother understanding it or what it means. So Bitcoin's got 38% volatility over the last year, and gold's got 13% volatility over the last year. And they're just telling you that there's a greater certainty around what gold's going to do than what Bitcoin's going to do. Now, 10 years ago, Bitcoin's volatility was 100%. So Bitcoin's way more certain today than it was 10 years ago. If you go to the stock market, stocks like Berkshire Hathaway, Johnson & Johnson, these sort of things, where there's it's not a great surprise when they report earnings. It's not a great shock. People know, well, maybe not Berkshire, but Johnson & Johnson, for example, or Coca-Cola or something. I mean, it's pretty predictable how much money they're going to make in the next 5-10 years' time. Yeah, compared to an oil company or a Bitcoin miner or a high growth company, you just don't know where they're going to be, and that's an important point, and that's reflected in the share price volatility pretty accurately, on average most of the time.
And do you own any first of all gold miners and B Bitcoin miners?
I don't only got Bitcoin miners, but I've got gold miners. Yeah, okay, all right. It's a really good time to own gold miners because they're trading dirt cheap.
Which ones do you like? Like what couple? Do you have any are juniors or big names or?
So at the moment, I mean, B2 Gold is North American. Their operations are in Mali and Colombia and Philippines and stuff like that. But it's just an underrated gold stock. Yeah, and then I got a couple of UK listed ones as well, which have done very well. But just if you just buy cheap things, and have a bit of patience. Things work out well. And by the way, my Bitcoin investment strategy for years, and it doesn't work anymore, but certainly in the 15, 16, 17 era, was all based on the same philosophy. You just looked at the size of the network, how many dollars were pouring across the blockchain each day compared to the market cap, and just did a discount premium kind of calibration, and it was pretty straightforward. That Bitcoin was a screaming buy in 2015 on those metrics, and stayed fair all the way through 16, and then the model sort of lost the plot in late 17. But I think that something's changed since then. It's become bigger than the model. So there are just too many inputs into what's going on in Bitcoin, and there's too much Bitcoin activity outside of blockchain, or off chain rather, and so it's actually quite difficult to measure the whole ecosystem these days.
Do you actively buy? Do you actively trade your Bitcoin? Do you actively change your position?
No. So bold is,
for example, did you sell during the 2021 run up, and did you just ride it right through?
Yeah,
right.
Basically
21, 22. I mean, the 22 crash. Did you just kind of I'll take it, and then you just kind of wrote it back up?
Well, I did actually sell a bit, but to be honest, Fred, I mean, I sold a lot of Bitcoin in 2017,
right,
at a very good price, and so I had a good run then. And it's very hard if I always admire the hodlers, and the best hodlers, of course, were tied up in MT Gogs because they didn't have
forced hodling.
Yeah, it's always been difficult, but I did let a lot go in 17, but I still had some. But my emphasis these days is bold, because the return of bold and the return of Bitcoin since the 2017 high is the same. But one has 15% volatility, and the other had 40% volatility.
Okay, and when you say bold, you mean the mix, the
mix, yeah. And the mix is not just owning both; it's rebalancing according to the model, which is the risk weighting. And so, when Bitcoin is very volatile, that means it's more dangerous, and when it's more dangerous, it's more susceptible to a large correction. It's not particularly volatile at the moment, so it's not particularly dangerous. But if you look at Nvidia, its volatility is really high these days. And that's just telling you this is not a great young investment. It's telling you it's a mature, dangerous investment.
Right. So if you had, I want to kind of wrap it up by the top of the hour, but so where do you kind of, what's your sort of macro thesis for, kind of post this election? Do you think the election matters? Do you think it's significant?
I'm sure it is, because you could just see the thing, can't you? You look at the Trump elected prediction thing, and basically everything correlates with that. So the market clearly does. But I think in the long term, these elections are irrelevant. But in the short term, of course, they mean everything. And I looked at bigger things, and I've become more and more. I think as you get older, you become more and more fundamental in your investment approach, and less interested by trading and short-term stuff. It's just how you evolve. I think when you've had 10,000 shit trades over 30 years, and you remember all the good ones. And the good ones you just left alone and let it run and thought harder about it, and you realize I just do less of the trading and more of the good stuff. And guess what?
That is so true, Charlie. I mean, I can't even remember. I've almost met nobody who got really rich day trading. I just don't know. I've never met that person, but I know tons of guys who got in on Intel, got in on Microsoft, got in early on Bitcoin, got in, so it's the big moves that make you rich. Yeah. It's not the small ones.
So if you want to do the trading thing, you want to be on the other side. You want to be the croupier. That's basically the lesson. The book
house always wins.
Yeah. House always wins. So I mean, it's just. I think the other thing I'd like to say, whilst I got the airtime with you, Fred, which I appreciate.
Perfect.
There's a money map thing that I did, which is basically there are 4 quadrants to investment, and above the line, if you're if inflation is high, then Bitcoin and gold do well. If inflation is low, then equities and bonds do well. Yeah, and then in a risk off environment, equities do well, Bitcoin does well. In a risk on environment, in a risk off environment, gold does well, bonds does well. So the difference between gold and Bitcoin is that one's a risk off asset and the other's a risk on asset. and both of them prefer inflation to deflation. Yeah. And those are two simple principles. And that's why they're not in competition. If Bitcoin's behavior ever changed such that it was correlated with gold, then you could say, oh my God, you've got a competitor here. You know, Bitcoiners should look at gold as, you know, their favorite granddad. They shouldn't look at it as, you know, some enemy that they're going to chomp away. And they're not going to, Bitcoin's not going to take over the central bank reserve for you know, if it ever did, which I doubt it ever will, but for a generation. I mean, at least, because it's just, you know, the central banks.
You're not a believer in the Bitcoin strategic reserve.
I believe in private assets and
Okay.
successful private assets. And so, you know, Bitcoin is there for you to buy and to own and to hopefully see it appreciate. Hopefully, it helps a lot of people out. It holds the system to account in different ways. It provides innovation to a whole load of shitcoins. You know, and there are 20,000 or 200,000 of them, and maybe one works, great. You know, maybe 10 work. You know, something happens from that space. Whatever. I mean, you know, I think you just let things go, and you encourage innovation, and what's wrong with that? So that's how I see it, and I just think it's gold's friend in the private sector. You know, gold very much came from the top. It was a top-down asset. It came from society, from the establishment, whereas Bitcoin came from the people. So there is a very fundamental difference there.
Yeah.
And I want to say another thing, and that is gold is the original financial technology. It's the original fintech, right? You go back 200 years in some ship and you sail around the world doing trade. You know, there's no cable, there's no satellite, there's no fiat currency, there's no spot price, but you have an ounce of gold. And so now you can suddenly fill your ship with tea or whatever else is you want to trade. And so if you think about it as a fintech, it all makes sense in its history. You know, it's hard to replicate, it's got a density, it looks like gold, these sorts of things. And that's pretty powerful. Now, in 1970, the system went, you know, we can't work with this gold anymore. It's causing too many pressures. It's too hard to live on the gold standard, just as it would be hard to live on a Bitcoin standard. But it goes up a lot in the 70s and the inflationary era, and then becomes irrelevant in the 80s and 90s. Yeah. But it starts to appreciate in the noughties. But it isn't until 2011 where the central banks start buying gold again for the first time since 1970, basically. And there was no document written anywhere saying central banks should accumulate gold. Indeed, the major central banks in Europe were selling gold. Like my country sold a lot of gold. Really, really stupid, but they did it. And in 2009, the Asian and emerging market central banks started to diversify the reserves into gold. And it's just been a big, big theme ever since. And it's not written down. They didn't have an agreement. They didn't say, well, this is what we should do. It just happened naturally. So this asset that's come in and out of human civilization for 5,000 years for different reasons, with different roles at different times, in different countries, has just come back naturally. And I think that's the fascinating thing about the current phase of the gold market.
We're going to end it there, but we have one question from the audience. Very important question. Is Cosmo a Labradoodle?
No, he's a cockapoo. It's the worst breed in the world. Don't get one.
Okay. Thanks a lot, Charlie. Really appreciate it. Thanks for your time. Thanks.
Thank you.